While the world focused on the New Year's countdown, the real event happened behind sealed vault doors in Shanghai. At exactly 12 p.m. local time on December 31st, 2025, the Shanghai Futures Exchange recorded its final trade of the year at $84.55 per ounce, nearly $13 above COMEX. This was not a price movement. It was a price fracture. On the surface, silver remained stable, trading at $72.15 in New York. But that number became irrelevant the moment 2.7 million ounces vanished from China's physical reserves. The paper markets were still quoting contracts. The physical markets were running out of metal. Over the next 36 hours, a system built on just-in-time supply, unallocated paper claims, and central bank liquidity will confront an immovable object, a legal wall of export control backed by the full weight of the Chinese state. This is not a prediction. It is a sequence already in motion. What follows is not a crash in the traditional sense. It is the moment when the paper silver price loses its authority, the arbitrage mechanism dies, and physical reality becomes untradeable at fictional valuations. By the time the markets reopen, silver will not merely be repriced. It will be redefined. While retail investors speculated on holiday equity swings and crypto volatility, a deeper signal emerged, not in a tweet or a headline, but in the price discrepancy between markets that no longer spoke the same language. On December 31st, 2025, the Shanghai Futures Exchange closed the year at $84.55 per ounce of silver. The COMEX spot price, quoted in every Western terminal, closed at $72.15, a 72.2% divergence between two listings of the same asset. At first glance, this appeared as regional volatility, a pricing irregularity caused by year-end positioning, perhaps localized buying pressure. But it wasn't. This was not a market anomaly. It was market divorce, the bifurcation of paper and physical. What the public saw was a price gap. What actually happened was the collapse of arbitrage. The invisible mechanism that keeps global pricing coherent had failed. A fungible commodity was no longer fungible. And the $12.40 spread was not a trade opportunity. It was a quarantine perimeter. This was the first and final warning. In theory, such a spread should not exist. Arbitrage desks exist to close these gaps. Buy low in New York, sell high in Shanghai, secure the metal, ship the metal, pocket the difference. But this time, the bridge was gone. A. On October 15th, China passed legislation restricting silver exports effective January 2nd. B. Refiners, traders, and industrial end users in Asia responded by front-loading orders ahead of the ban. C. This triggered a demand surge in Shanghai and the surrounding region, pushing up the local price. D. Arbitrage desks tried to respond, buying COMEX contracts to deliver metal to Asia, but faced a hard wall. Physical shipping could no longer settle in time. Logistics, insurance, customs, and export licensing formed a bottleneck. Arbitrage became an illusion. The gap remained open because the metal could not move. This was not a price dislocation. It was a liquidity vacuum forming between two disconnected markets. Historically, these gaps have appeared during momentary shocks, COVID supply chain halts, the 1980 Hunt Brothers silver squeeze, or the 2022 LME nickel implosion. But in each case, temporary rule changes were deployed to contain the panic. In 1980, COMEX raised margin requirements to force deleveraging. In 2008, central banks flooded repo markets with liquidity. In 2022, the LME retroactively canceled trades. This time, the response mechanism is absent. The problem is not speculative, it is physical. There are no margin hikes that can unlock a shipping route. There is no swap line that can fabricate time. The arbitrage spread has gone from profitable to unsolvable to permanent. Western liquidity desks are exposed. Every day the spread persists. Paper short sellers bleed risk. Their models, designed around rolling contracts and closing spreads, are now colliding with the reality of static inventory. The signals are subtle but absolute. Retail bullion dealers in the West are listing $12,000 $15 premiums on U.S. Silver Eagles. Generic silver rounds, typically $1 over spot, are now quoting $8 premiums. Shipping times are drifting from 3 days to 6 weeks. Meanwhile, inventory reports from COMEX show a drawdown in registered bars, the only category available for delivery. Eligible silver remains untouched, but cannot be allocated without specific permission. The usable pool is shrinking. In Shanghai, the vault drain has begun. Daily withdrawals are running at 42 tons per day, up from a baseline of 2 to 3. The vault is not being depleted, it is being emptied with intent. The spread between the screen and the dock is now the defining metric of this market. We are no longer dealing with volatility. We are witnessing monetary dislocation. Understood. Metric tons of silver, not a rounding anomaly. This was a strategic depletion event, state-owned inventories, no central bank statements, just movement, fast, coordinated, and absolute. What the public saw was a futures contract closing strong. What actually happened was a national metal evacuation. The scale was not industrial, it was preemptive. China's silver export ban, set to activate on January 2nd, triggered not just buying, but hoarding. At the same time, premiums on the Shanghai Futures Exchange surged to 84.55, implying desperation, not speculation. A run had begun, and Shanghai was the first vault to fracture. This wasn't random. It was the inevitable result of a legal deadline converging with strategic foresight. A. In Q4 2025, China announced new restrictions requiring export licenses for silver shipments beginning January the 2nd, citing strategic resource protection. B. Industrial buyers, solar, EV, and electronics manufacturers interpreted this correctly. Supply constraints would worsen and prices would no longer be internationally anchored. C. Government-aligned entities, already allocated quotas, began withdrawing registered bars from the exchange and moving them to untouchable storage. D. Foreign firms, aware they would be locked out post-deadline, accelerated forward purchases, depleting inventories faster than replenishment could occur. The result? The Shanghai Vault experienced what can only be described as a vacuum event. Metal was being pulled at a speed that outpaced any prior precedent. Logically, this created the next stage in the chain, a supply bottleneck, not just in trade, but in truth. Once the vault data posted, no Western market could continue pretending the global silver price was $72. This was the inflection point. In prior market distortions, such as the 2020 palladium squeeze, temporary shortages resolved with price hikes and physical substitution. But silver holds no substitute in electronics, solar, or medical-grade conductivity. Today, the same threshold has been crossed, but with state involvement, not retail speculation. The system is no longer under pressure. It is in extraction mode. The divergence between institutional behavior and public pricing is now visible. Western dealers quote silver at $72 on their platforms, then list "alert me when available" on physical stock. No dealer will commit to delivery below 83 or 85. Middle Eastern trading hubs, particularly Dubai, are reporting verified physical transactions at $79.61, confirming a second regional benchmark independent of New York or London. The arbitrage model, paper in New York, delivery in Asia, has collapsed. Traders can no longer ship in time, and China will not ship at all. Every ounce removed from Shanghai's vault is non-returnable. It is now domestic stock, outside the arbitrage loop, outside of Western pricing control. There is no mechanism to reverse this drain. Only acceleration remains. On December 30th, the COMEX delivery board was quiet. Just 69 silver contracts stood for physical settlement, barely 345,000 ounces, typical for a market dominated by rollovers and speculative churn. By the morning of December 31st, that number had changed, violently. 147 contracts now stood for delivery, over 9.2 million ounces, a 26-fold surge in physical demand within a single 24-hour session. This was not price discovery, it was position collapse. What the public saw was a chart holding at $72. What happened in reality was that nearly 2,000 counterparties hit the deliver button simultaneously. For years, COMEX has functioned as a cash-settled, paper-heavy marketplace. Most participants never intended to receive metal. But now, facing an $84 price in Shanghai, firms holding cheap paper began demanding bars. This was not a rotation. It was a run. Paper markets are designed around confidence. Delivery is optional, not standard. That works until it doesn't. A. The $12 spread between New York and Asia created an immediate arbitrage incentive. Firms could buy at $72 and sell at $84 if they could take delivery. B. As word spread about Shanghai's vault depletion, large holders of COMEX contracts began executing physical settlement orders to front-run the supply crunch. C. Bullion banks on the short side, those who had sold the contracts expecting cash rollovers, were caught flat. D. To avoid default, they turned to the Federal Reserve's repo window, seeking emergency liquidity to fund metal acquisition at elevated prices. The result was a margin chain reaction. The sellers owed metal. The metal was priced higher elsewhere. The loss per ounce widened as the Shanghai premium grew. This wasn't delivery. It was forced physical redemption under duress, analogous to a margin call on inventory, not capital. When COMEX saw this spike, it did not halt trading. It did not hike margins. But it did quietly move into containment mode. This playbook has precedent. In 1980, after the Hunt brothers cornered silver, the exchange shifted to liquidation only. In 2022, the LME canceled billions in nickel trades to prevent systemic contagion. This time, the response is more subtle. Instead of outright cancellation, liquidity was used as buffer capital. Over $5.8 billion in emergency repo operations were executed by the Federal Reserve between December 30th and 31st. This capital wasn't for growth, it was for survival, used by bullion banks to cover delivery at a loss and avoid technical default. The stress is visible on bank balance sheets. JP Morgan reportedly increased loan loss provisions for its commodities division by $400 million overnight. Citibank issued internal memos warning of settlement congestion. The system isn't hedged, it's hemorrhaging. The key indicator is bar availability. COMEX's registered inventory, the deliverable pool, was already thin before this spike. With 1,847 contracts now standing, 9.2 million ounces must be sourced immediately. Dealers are not blind. Silver premiums in the U.S. surged past $12 per ounce, with generic rounds quoting $8 above spot, a level typically seen only during systemic fear. More critically, delays began to surface. Major dealers like APMEX and JM Bullion shifted their inventory to pre-order status, with shipping times of 4 to 6 weeks. That's not a wait list, that's supply chain paralysis. Every COMEX contract that demands metal at 72 creates a new cash hole for a bank who must buy it at 84 or higher. And with Shanghai closed for export, the supply pool is no longer global. New York has become an island of paper contracts in a world running out of metal. This is not a liquidity crisis. It is a metal crisis. Priced in dollars, the system can print, and silver, it cannot. In the final trading sessions of 2025, silver left the financial system. Not as contracts, not as options, but as tons of refined metal vacuumed out of exchanges, refiners, and wholesale pipelines. This was not retail stacking, it was industrial scale withdrawal. We have confirmed that in addition to the 84 metric tons pulled from Shanghai, emergency procurement orders were executed by major manufacturers. Samsung, according to supply chain intelligence, secured 6 months' worth of silver inventory in a single allocation. Tesla's solar division authorized buyers to pay above spot as necessary for immediate physical settlement. The guidance bypassed price entirely. This is not a trend. This is strategic resource capture. What the public saw was a coin shortage. What actually happened was the collapse of the just-in-time supply model for one of the world's most irreplaceable metals. For decades, industrial procurement has been optimized for capital efficiency. You don't hold metal, you schedule deliveries. The system relies on predictable pricing, short delivery windows, and abundant liquidity. But the silver market has 3 constraints that broke the model. A, first, it is small. Global annual production, 1 billion ounces, is fully absorbed by industrial demand, jewelry, and investment, leaving no slack. B, second, it is irreducible. There is no scalable substitute for silver in electronics, photovoltaics, or medical-grade applications. C, third, the paper market concealed true scarcity. When physical premiums spiked and delivery delays appeared, firms saw the signal. D, the result was a scramble for atomic inventory. Companies abandoned just-in-time and front-loaded supply for the next 6 months. The analogy is a warehouse fire. When the sprinkler system fails, everyone races for the exit. No one cares about price. They care about survival. As corporate buyers hit the metal markets, the institutional layer followed. Wholesalers raised minimum order sizes. Refiners received bulk orders at any available price. Delivery guarantees collapsed. COMEX contracts for February began quoting open interest levels inconsistent with physical availability. Dealers began limiting quantities. Some removed listings altogether. This is the second-order effect. Once industrials begin hoarding, supply no longer cycles. It sticks. Every ounce moved into a factory stays there. It doesn't return to the exchange. Western financial markets, trained on price signals, are still lagging. They interpret $72 as stability, but the real indicator is movement. Silver is not trading, it is being absorbed. The stress ladder is rising. Premiums rising. Delays lengthening. Volume drying. Offers disappearing. This is not volatility. It is systemic illiquidity in the physical layer. Coin shops are the surface. Supply chains are the root. Silver Eagles now command $12, $13 premiums, with some dealers quietly removing purchase limits. Generic bars quote $8 over spot, nearly a 1,000% premium increase from normal market conditions. But beneath retail, the more dangerous signal is this. Wholesalers are turning to no offer. That is not pricing behavior. It is rationing. We've confirmed that certain industrial suppliers have shifted from pricing contracts to allocating inventory based on strategic priority. In simple terms, if you are not essential, you are not being filled. Every system from Shanghai to Dubai to Texas is now quoting physical silver between $83 and $85, a silent consensus that the COMEX price no longer reflects anything real. And still, demand accelerates. The price on the screen says $72, but the metal is gone. At midnight on January 2nd, 2026, China's silver export ban became active law. No extensions, no grace period, no exceptions. Every ounce of refined silver inside China's borders became a strategic asset locked behind regulatory firewalls. On the surface, global markets opened calmly. COMEX resumed trading. Spot held above $74. But what appeared to be stability was, in fact, Inertia. The real market didn't open. Major dealers across the US, Europe, and the Middle East began quietly informing clients of delayed shipments, delivery holds, and in some cases, canceled fulfillment agreements. They invoked a term the public rarely sees: force majeure, unforeseeable circumstances, regulatory change, supply chain failure, legal justification for default. What the public saw was a chart. What actually happened was the system's legal firewall activating under strain. Force majeure is not about price. It is about plausible non-performance. A, when China sealed exports, the global arbitrage mechanism was severed. Metal bought in New York could no longer be sold in Asia. B, institutions relying on that arbitrage were now underwater, forced to deliver physical they did not possess at prices they could no longer hedge. C, with premiums rising and inventory drying up, suppliers could no longer fulfill contracts at pre-ban terms. D, the only escape was legal, triggering clauses that allow non-delivery without penalty under extraordinary conditions. What began as a price divergence became a contractual fracture. The analogy here is musical chairs. The music stopped, the chairs vanished, and the legal teams moved faster than the traders. We've seen similar playbooks before. In 2022, the LME invoked force majeure on nickel trades during a squeeze to protect a single counterparty. In 2020, refineries cited COVID-related lockdowns to delay bullion deliveries. In 2008, physical settlement desks quietly deferred shipments to preserve liquidity during credit seizures. But January the 2nd marked something different. Force majeure is no longer tactical, it is systemic. Multiple wholesalers issued blanket notices of administrative delay. Translation, we don't have it. Industrial suppliers began offering cash settlements in place of metal. Clients were refunded at $72 spot for inventory, now trading at $84 on the physical market. This is not a market, it's a settlement triage system. As the legal shields rose, confidence collapsed. Contracts were now suggestions. Settlement optional, premiums untethered from spot. Default risk moved from hypothetical to pricing in. Premium spreads became diagnostic. Where force majeure was invoked, premiums spiked overnight. U.S. dealers raised Silver Eagle prices to $86.88 per ounce. Generic rounds moved to $80 or higher. Canadian maples, normally a mid-tier product, became unavailable. Pre-orders pushed into Q2 delivery windows. Wholesalers stopped quoting bulk rates. Retailers introduced new clauses disclaiming liability for delays due to regulatory uncertainty. Vault data went stale. Major custodians did not update bar counts for 48 hours. Settlement desks were reportedly instructed to pause ledger movements until further guidance. And behind it all, institutional buyers began withdrawing requests. Not because they didn't need metal, but because they no longer trusted the delivery promises. A contract priced at $72 is meaningless when fulfillment requires a force majeure clause. What remains is the physical market, and it is not asking for permission. At 8:30 a.m. Eastern Time, January 2nd, 2026, the COMEX silver market opened flat. Spot price, $74.10. There was no spike, no breakout, just silence. The ticker resumed, the quotes updated, but the system beneath them did not move. What followed in the next 60 minutes was not a rally. It was a realization. Buyers attempted to place orders at spot. Dealers refused to fill them. Physical inventory was either unavailable or quoted at $85 and rising. This was not volatility. It was the moment the screen price detached from physical reality entirely. The paper market still printed numbers, but the physical world had already repriced. The futures market relies on implied convergence. That is, futures and spot prices should align at contract maturity through arbitrage and delivery, but the system no longer converged. A, the Shanghai price held above $84.55 with no export outlet. B, COMEX paper sat at $74.10 with delivery queues months long. C, arbitrage traders couldn't move metal. Export bans, freight delays, and regulatory holds had turned the arbitrage loop into a dead circuit. D, without a functional convergence mechanism, the paper price became a synthetic relic, detached from the deliverable asset it claimed to represent. The analogy is a shadow auction. A bid on a product that no longer exists, still accepted because no one wants to admit the catalog is empty. The futures market kept quoting, but no one could collect. This is the final stage of breakdown. First comes price divergence, then comes inventory drain, then comes delivery failure, finally comes credibility collapse. We've seen fragments of this before. In 1980, when silver soared to $49, COMEX changed its rules overnight to halt delivery and protect counterparties. In 2022, the LME froze nickel trading entirely, citing disorderly markets. In 2020, precious metal ETFs began to trade at deep NAV discounts as bar availability diverged from contract float. Now we have all elements at once. No inventory, no exports, no arbitrage, no trust. The institutional layer is responding quietly. Hedge funds are reducing exposure. Refiners are cutting forward contracts. Vaults are no longer listing bar counts publicly. And behind the scenes, settlement systems are being rewritten. COMEX is no longer a delivery vehicle. It is a pricing museum. This is how the new market expresses itself. Silver Eagles, $88 and rising. Canadian Maples, $86, limited quantity. Generic bars, $82, with 5-week delivery windows. Spot price, $74.10. The spread is not temporary, it is structural. The $8.14 difference is no longer a premium. It is a credibility discount applied to the screen. Industrial procurement desks are ignoring spot quotes. They're building pricing models based on live market fills, not futures benchmarks. Every signal now reinforces the same conclusion. Paper supply is unlimited. Physical metal is not. Settlement is uncertain. Default risk is implied. And still, the screen prints numbers, not because they are true, but because the terminal cannot go blank. Final intelligence conclusion. The screen price is no longer a reference. It is a remnant. The real market has moved offshore, off ledger, and off script, and no amount of liquidity can refill a vault that has already been emptied.